All right, let's just jump right in, because today we are tackling something that brings a healthy dose of dread, a massive amount of confusion, and honestly, sometimes even some unearned joy to millions of us every single year. Yep, it's tax season. Specifically, we're using this explainer to break down the great tax confusion that trips up so many of us when we finally sit down to look at our numbers.
So tell me if this sounds familiar. Have you ever gotten a tax refund and thought to yourself, awesome, I paid less tax this year? Or, maybe you've been on the complete opposite side of the fence. You're staring at a bill from the IRS, totally stressed out, thinking, how is that even possible? They literally took taxes out of my paycheck every single time I got paid. Listen, if you've ever felt this weird paradox, celebrating a refund or totally panicking over a balance due, you are absolutely not alone.
Section 1. Defining tax liability, the foundation.
To clear up this confusion once and for all, we gotta start at the absolute foundation. Tax liability is the total amount of federal income tax you legally owe for the year. That's really it. Think of it as your final, definitive tax bill. After all your income is calculated, your standard deductions are taken, and your credits are applied. The absolute most crucial thing you can realize today is that this number, your actual tax liability, has absolutely nothing to do with how much money was withheld from your paychecks.
Let's look at a quick example to really cement this idea. Meet Sarah. Sarah earned $70,000 this year. After she takes her standard deduction and claims any tax credit she's eligible for, her actual legal federal tax liability comes out to exactly $5,500. So regardless of what happened on her paydays, $5,500 is what she officially owes the government for the year.
Section 2. Anatomy of a refund. Sarah scenario.
Okay, so what actually happens when those automatic paycheck deductions are finally factored in? Well, throughout the year, Sarah's employer withheld $6,300 from her paychecks. But remember, her actual tax liability, what she legally owes, is only $5,500. So we take the $6,300 she already paid, subtract the $5,500 she actually owed, and boom, we get our result.
An $800 tax refund. That is exactly what a refund is. The IRS is simply taking that extra $800 she sent them throughout the year and returning it to her. She didn't pay less tax than she owed, right? She just paid way too much up front.
And this brings us to a phrase I want you to remember forever. It's not free money. I know it feels like a bonus, it totally feels like a gift, but it is literally just Sarah's own money being handed right back to her because she overpaid during the year.
Section 3. Why you might owe. John's scenario.
Now, let's look at the flip side of this. John has the exact same tax liability as Sarah, $5,500. He owes the exact same amount for the year. But over the course of the year, his employer only withheld $4,700 from his paychecks. So when he finally files his tax return, he comes up short. He owes a balance of $800 to the IRS.
Now, seeing that you suddenly owe $800 can cause some immediate panic. But here's the reality. It's not a mistake. It's really just a math mismatch. This doesn't mean John did anything illegal or wrong. Actually, this is incredibly common for self-employed workers, freelancers, investors, or really anyone juggling multiple income sources where those automatic withholdings just don't capture the full picture.
Putting these two side by side illustrates the core concept perfectly. Sarah overpaid during the year, so she gets a refund. John underpaid during the year, so he owes a balance. But their tax liability, their actual tax burden, was identical. It's all about the withholding strategy, not the final tax bill.
Section 4. The free money myth. So, if it's just our own money coming back to us, why do so many people celebrate a massive tax refund? Well, the reality is, a large refund is actually just an interest-free loan to the government. Think about it. You let them hold on to your extra cash for 12 months, they used it, they didn't pay you a single cent of interest for the privilege, and then they finally just gave it back to you in the spring.
Imagine getting a massive $4,000 refund. I mean, it feels like hitting the jackpot, right? But in reality, that $4,000 means you overpaid by about $333 every single month. That's $333 missing from every paycheck that you could have used to pay off debt, invest, or just cover your daily expenses. Instead, you just waited until tax season to get your own money back.
Now, it's really important to point out that there is no universally right answer here. Some people intentionally choose larger refunds because they treat it like a forced savings account. It physically stops them from spending that extra cash every month. Others prefer adjusting their withholdings so they get bigger paychecks and way more control over their cash flow year-round. Neither choice is wrong. It strictly depends on what your personal financial goals are.
Section 5. The simple tax formula.
To wrap this all up, here are the golden rules to demystify every single future tax season. Ready? Your tax liability is what you actually legally owe. The taxes withheld are what you've already paid. Therefore, if what you paid is greater than your liability, you get a refund. And if what you paid is less than your liability, you have a balance due. It's simple, elegant, and completely logical.
So I'm going to leave you with this final thought to ponder. Are you giving the government an interest-free loan? Take a look at your paychecks, review your withholdings, and really decide if your current tax strategy is actually serving your best financial interests.